Welcome investors, I'm Adam Carlini. With me is Grant Haddon. Also with us today is Gary Luna. We are Dynamic Wealth Management. This is the investment and market update for January 27th, 2016. And I don't know what's worse, the market, the decisions the Federal Reserve is making, or the way that the Cardinals did not show up to play the Panthers. What do you think, Grant?
I think the Cardinals' loss was definitely more emotional because it's final, it's done, but the market still has a chance to pick up here. So the market really can't decide which way it wants to go, but let's jump into the video and we'll show you what we think is going to happen.
Sounds good. All right, here's our update for January 27th, 2016 for Dynamic Wealth Management. We'll go ahead and see what upcoming events we have. We have investments for breakfast. That's at 9 a.m. in our office, in our conference room. The next one is Tuesday, February 2nd. After that, 2 weeks later, February 16th. We'd love to have you here. It's an open discussion about markets, strategies, what's going on. Love to hear your comments and love to bring you up to speed with our models and what we're seeing and what we're doing for our clients. Also, we have tomorrow night an investment seminar, January 28th. If you're still interested in that, it's kind of short notice, but give us a call and we'll see what we can do. So the number here is at the bottom. Now, on to this week. First off, for those who are in our ETF model, our core ETF model, you know that last week we were pretty deep into the bearish red. The market rallied this last week, almost got us into the neutral zone, but we were still in the bearish territory. And after you see what happened today, you'll be glad that you are. As far as the economy and upcoming events, things that have happened this week, new home sales came out. Actually, new home sales was a positive piece of news today. You can see that there was a nice increase in new home sales reported for the month of December. And so that's a positive for the economy. We'd like to see that, especially in Arizona. Today was the day where the Federal Reserve finished their two-day meeting and gave us their wisdom on what's going to happen with interest rates. You can tell by this picture, it looks pretty dismal. It looks like a cemetery. It doesn't look like a bunch of headstones there with the guy with his head down out there in front of that federal building. So they made a pretty dovish statement after their two-day meeting. They basically said nothing of any importance. Basically, nothing we didn't already know. Rates are going to remain low in the near term, and although they did admit now that the economy has slowed. Previously, they were saying that the economy was still pretty strong, and they're not saying that now. They're admitting that it's slowed, and the expectation, they had been forecasting up, probably 4 interest rate increases this year. At our previous breakfast club, Investments for Breakfast, we indicated we didn't think that was going to happen. And after the most recent data and their comments, it's looking even less likely that interest rates are going to rise 4 times this year, if at all. In fact, even before their announcement today, the likelihood for a rate hike in March was 29%. That will be significantly less after the FOMC meeting that we just had today. So the next time we see this, that number would be quite a bit lower tomorrow. So the next meetings after that are in April, June, July, September, November, December. We skip months now and then. So the next FOMC meeting will be in March and then April. And right now it looks like they're not going to raise rates in March. It's our opinion that they're not likely to raise rates after June since it's an election year. So we'll see if they're ever going to raise rates again. Maybe they'll even have to stimulate if things get as weak as it appears they are. Just to give you an idea of some of the problems in the market today, Apple Computer used to be a great mainstay. A lot of people hold Apple, a lot of mutual funds hold Apple. Apple's down 29% from its all-time high back in May, which is also when the market peaked. So the market has been teasing us along the way, trying to do something, looking like it might go higher, but gradually moving lower, and Apple especially has suffered in that time. And their earnings that came out last night were not positive, and their guidance, nothing was great about their report. Apple stock down 6.5% today on bad earnings. Another big stock that makes it's in the major indices was Boeing. Boeing also hit hard today. In fact, worse than Apple. With the tax issue that they have to resolve. So 2 big stocks, those did weigh heavily on the markets. Although interestingly, the market managed to be positive before the FOMC's interest rate announcement. And again, the announcement was there is no change, no interest rate increase or decrease, just a more admission of the reality of things are weak. Earnings has been coming down, but not only has earnings been coming down, but also sales are down. So look, check out this chart. Here's the S&P 500. It's going all the way back to 2000, 2001. Okay, and you can see how it's moved. Here's sales growth. Okay, notice when sales growth is declining, usually the market's declining. When it's rising, the market tends to rise. But we got a couple of disconnects here. So, for example, you'll notice back here in 2006 and 2008 that sales growth was in a decline while the market continued to go up and then finally began to participate in that decline and came down just as sales did. Then sales rebounded, sales growth did, and the market rebounded. But notice, since about the middle of 2011, sales growth has been on the decline while the market has continued to go on a tear. So this is a major aberration, and it is now correcting. We're now seeing the market come back down because you've got to have sales growth in order to support your stock prices. Same thing with earnings. We've had weaker earnings now for 4 quarters in a row. So this is according to FactSet. This is the longest negative streak for sales growth since the 4-quarter sales growth stretch of 2008 that went into from 2008 to the 3rd quarter of 2009. And we know what happened back in that time frame. It was a disaster for the market. So this does not bode well for the market. As far as important upcoming news, we've got tomorrow we've got durable goods orders. That may have some impact. Jobless claims, of course, is going to have some impact. And then on Friday, GDP numbers come out and the Chicago PMI, consumer sentiment as well. So those are upcoming things that could have an impact on the markets. We'll now go over to Grant and have him comment and show you some graphical examples of where the market's been and where we think it's headed, and at least where it's showing us that it may go.
All right, Adam did a good job giving us an update of what's happening out there in the economy. Let's see how that has been affecting the market. So real quickly, here is the different sectors over the last week. But I do want to point out that the S&P 500 year to date, or the market, is down 7.9% year to date. Okay, so we've had a bounce in the last week. Things have gone well. So U.S. stocks are up, and this is just the last week, the last 5 trading days, right? International developed countries are up 4%. Emerging markets up almost 4%, 3.5%. Real estate investment trust REITs are up 4.8%. High yield bonds up 2%. Commodities even up. Pretty rare. And the treasuries are down just a little bit. So this has actually been a risk-on week, and we've seen a bounce. So let's jump in the S&P 500, and I'll show you what that looks like. So again, here's the beginning of the year, right? Started right here. So we're definitely down from there, and down 7.9% after today's move. And here's that last week, though, that you've seen. It's kind of had this little bounce back up. Now, again, we point it out every week, but this line is very key. It goes off of the previous lows that we saw. We saw that low in 2015 in August, and it came back down right at the beginning of October, end of September, and ran up, but now is right back down in the same place. So we're watching this very carefully. Once it decisively moves away from or below this line, it's going to make a big difference with what we anticipate for our clients. The great news is that year to date, all of our models, all of them have significantly outperformed the market. None of them are down like the market is down. So we have successfully protected our clients, which is what we aim to do. Here's a zoomed in picture of the same thing. This is just the last 10 days, and that's that same line that we were talking about here. So it kind of dances, it comes down and touches it, moves back off of it. Here it broke through, but it's interesting because this day actually closed really close still. So even though during most of the day it was down here, it closed up here. And then it's just kind of stayed right around. And today actually just today, it was down, came down, touched it, and bounced off of it. So we really are watching that line really carefully. It's definitely going to change everybody's outlook once something breaks with a strong confirmation one way or the other on that. Here is the price per barrel of oil. Of course, we know it's been coming down, but actually, if you look at the last 2 weeks, each one of these little candles is a week in time. The last 2 weeks were strong up weeks for oil, and that's a big reason why we've seen this little rally in the market as well. So with that being said, where are we allocated? What are we doing? It was said at the beginning of our video, but we're still in the red zone. So in the red zone, our allocation is the same for everyone in our core ETF model. We're 100% defensive. We are not putting our clients at risk until we see a little bit of a confirmation that the market wants to move to the upside. So we are completely defensive. Whether you're a growth client, conservative client, we're conservative and actually trying to make a little bit of money as the market falls. So with that being said, we want to get our disclosures out there, let you know that this is not a recommendation to buy or sell anything. We're just giving you some good information, giving you our opinions. You should always consult with a financial professional before you make any financial decisions. Thank you so much for watching our video. If you can come out to any of our upcoming events, we'd love that. Remember, we have a breakfast club coming up on Tuesday here at our office at 9 o'clock a.m. Everyone's welcome. Thanks for watching our video. We'll send out another one next week.